Trade policies have always been a critical aspect of global economies, and recent developments in U.S. tariffs have sparked market volatility and discussions around the impact on inflation.
Equity markets were broadly down, the U.S. short-term yields were up, and in U.S. inflation expectations rose a bit. Suggests the markets are of the view that these tariffs would weigh on U.S. growth, likely push U.S. inflation up, and could prompt the Fed to respond.
The latest tariff announcements by President Trump have sent ripples through the market, affecting various sectors and raising questions about their long-term impact.
President Trump sees trade, particularly tariffs, as an all-purpose tool of economic and foreign policy. He believes tariffs can address a range of issues, including reducing U.S. trade deficits, raising revenue for the country, negotiating with countries on matters of economic and national security. There's really a variety of uses in his mind.
But what exactly are these new tariffs? And how will they influence U.S. companies, global supply chains, and the broader market? Welcome to The Bit, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. Here to help me understand these developments is Glenn Purves, Global Head of Macro in the BlackRock Investment Institute, and Kress, Head of Geopolitical Research and Strategy at BlackRock. Together, we'll delve into the rationale behind the recent tariff decisions, their potential macroeconomic impact, and the implications for investors. We'll also discuss the investment opportunities and risks associated with these tariffs, the influence of geopolitical tensions, and key takeaways for investors looking to navigate the evolving trade landscape. Catherine and Glenn, thank you so much for joining us on The Bid.
It's great to be back.
Thanks for having me.
So we're here to talk about U.S. trade policy. And over the last few days, there's been a lot of announcements around tariffs that the U.S. announced. Some have been implemented, some have been delayed. We've also seen other countries retaliating against the U.S. because of some of these announcements. So, Catherine, maybe I could go to you. Help us make sense of all the events that have taken place over the last few days, and what are you watching for next?
Thanks, Oscar. So certainly a lot has happened. In the last few days, we saw some of the first truly significant steps taken by the Trump administration on trade. So if we rewind, on Saturday, February 1st, President Trump announced that the U.S. would soon be implementing 25% tariffs on all goods from Mexico, all goods from Canada, with the exception of Canadian energy resources, which would face a 10% tariff, as well as 10% tariffs on all Chinese imports. And on China, the important thing to note is that the 10% rate would come on top of any existing tariffs in place. President Trump announced the tariffs by executive order, and the orders detailed actually a number of other measures that the administration would take, including 1, escalating the tariffs further in the event of retaliation by Canada, Mexico, or China, and 2, closing the so-called de minimis trade channel that essentially waives tariffs on small packages valued at $800 or less. This is especially significant for China, given Chinese shipments account for a large portion of de minimis imports into the United States. In announcing the tariffs, President Trump claimed executive authorities provided by the International Emergency Economic Powers Act, or IEEPA. IEEPA gives presidents sweeping economic powers during a national emergency, which allows them to bypass most regulatory checks and move quickly in taking action. In this case, the executive orders cite the flow of migrants and illegal fentanyl across the U.S. national border as a national emergency. Fast forward to Monday, 2 days after the tariffs were announced, 1 day before the tariffs were set to take effect, we learned that Mexico had reached an agreement with the U.S. to delay the tariffs by 30 days. Mexico promised to bolster the National Guard presence along the border with an additional 10,000 troops. Later that afternoon, Canada reached a similar arrangement, promising to increase border security, appoint a fentanyl czar, and other steps. So where are we now? As of today, the 10% additional tariffs on Chinese imports are in effect. China has announced a number of retaliatory steps, including tariffs on U.S. coal, LNG, crude oil, agricultural machinery, and a number of automobile categories. Those are set to take effect on February 10th. Export controls on critical minerals were also announced by China. Those are key to a number of advanced technologies. And finally, China has announced steps against a number of large U.S. companies. As you look through these retaliatory steps, you can see they were carefully calibrated so as to allow for potential negotiations with the U.S., but they also show that China was prepared for the U.S. to take these steps. So in terms of what I'm watching for next, I would highlight 5 things. One is whether the tariffs on Canada and Mexico do in fact go into effect on March 3rd, as currently planned. President Trump noted that Secretary of State Marco Rubio and Howard Lutnick are prepared to begin negotiations with Mexico on an unspecified issue set. He also indicated that he would try to reach an economic deal with Canada in the coming months. Second thing I'm watching, though, is if these negotiations fail, whether Canada and Mexico retaliate. And I'll be looking to see what retaliatory steps they take. Canada previously outlined detailed plans targeting politically sensitive goods in the U.S., whereas Mexico promised a range of tariff and non-tariff measures. So the back and forth there could escalate the conflict further. Third, I'll be waiting to see whether President Trump and Chinese President Xi Jinping have a call in the coming days, as has been suggested they might do. Whether they're able to reach some form of an agreement to roll back the 10% U.S. tariffs on Chinese goods, as well as delay the imposition of the Chinese retaliatory steps. Reports suggest the U.S. is looking for a so-called grand bargain with China, touching a range of economic issues. Fourth, if the Chinese retaliatory steps do take effect on February 10th, we'll have to see if the U.S. escalates further, given that escalation clause in the executive orders. President Trump characterized the 10% tariffs on China as an opening salvo. He said that if we can't make a deal with China, then the tariffs will be very substantial. So we're watching that. And then last, I'll be monitoring whether there are any legal challenges to Trump's executive orders, which could impact their ultimate implementation. Bottom line, it's a very volatile situation. It's moving quickly. A lot has happened. A lot could happen. So we're monitoring it closely.
Catherine, there's definitely a lot to follow there. It feels like markets are looking at things like earnings and interest rates and GDP growth, and now tariffs are a major variable to consider. And so, Glenn, how did markets react to the news? On the one hand, we're learning a lot of new information this week, but on the other hand, it's perhaps not a complete surprise. The threat of tariffs has been signaled by the U.S. administration. So what was the reaction, and what does this mean for U.S. companies who have complex global supply chains and that derive a lot of revenue from the U.S.?
Thanks, Oscar. I thought Catherine laid out the complexity and the uncertainty quite well. And in general, the markets moved intuitively on the initial tariff move. Equity markets were broadly down. The U.S. short-term yields were up. And in U.S. inflation expectations rose a bit. Suggests the markets are the view that these tariffs would weigh on U.S. growth, likely push U.S. inflation up, and could prompt the Fed to respond. And you're right to highlight the complexity of the global supply chains, absolutely. And that's a critical driver of how U.S. tariffs affect domestic companies. There are some companies that are pretty insulated. They don't depend on imported goods to produce their own output. And production itself is entirely within the U.S. But most prominent sectors have more complex production chains that straddle the borders. Auto production is a great example of that, where producers have tightly integrated supply chains across both Canada, Mexico, and alongside the U.S. Take a crankshaft or a car seat, for instance, before it makes it its way into final assembly in the car. Those are instances where they cross the borders multiple times before being finalized. And it's a good example of why we saw on a sectoral level the equities of U.S. auto producers being particularly impacted compared to the rest of the market after the tariff announcement this weekend.
Right. So markets were impacted, generally a sort of negative reaction. Certain sectors acted more than others. What about the macroeconomic impact of these tariffs? Glenn, you mentioned that yields went higher. Is that a signal of the market's interpretation of what this could mean for inflation? Maybe talk a little bit about what it means for the economy now.
Sure. And Catherine did mention many of the complexities and touched on some of the intent of the tariffs. But having a view on the intent of the tariffs to be able to answer that question is really important. And there seems to be a dual purpose at this point. The destination seems to be a permanent and universal tariff as a tax. The fact that the new administration has ambitions to create an external revenue service seems to conclude that this will be a permanent feature of U.S. fiscal policy. And we think around 10% is probably the going spot for that tax. And the reasons are that, as Catherine mentioned, tariffs were levied on Chinese imports at about 10%. And as well, it was proposed at 10% for Canadian oil coming into the U.S. And the U.S. is very reliant on a lot of that Canadian oil still. En route to that destination, we're also seeing tariffs as a negotiating tool. 25% were proposed for Canada and Mexico, even Colombia, before all of it was paused. And in all three cases, the pauses came after committed actions by all three countries came to be. This distinction is important from a macro perspective because if it's just a 10% tariff and the rules are clear and it's widespread, the macro impact is more focused on the first order elements. And the key question is really how it's passed through to U.S. producers and consumers in the form of inflation. But adjustments to supply are a bit faster in the world. It's broadly spread out. There's no real substitution for accessing supply. And so it has an inflationary impact, of course, and it's going to have a growth impact. If there continues to be lingering uncertainty about higher tariffs at the 25% level, it would prompt more second-order impacts. And we think changing some of the hardwiring of supply chains, more substantial investment and production changes at the firm level, reconsideration of the markets the firms want to be in, and even more active policy and retaliation beyond just the tariffs. We've seen buy domestic from other countries involved. And because of these compounding second-order effects, we think that the impact in particular on growth would be more magnified in that scenario. But in the end, from a macro standpoint, this all has to be netted out with the many macro enablers going on in the U.S. Regulatory reforms, energy competitiveness, IT investments, and even the upcoming tax package being considered for later this year.
So there is unquestionably an impact on the economy, but the more significant impacts could be if the tariffs go above that 10% level that you mentioned. If 25% tariffs become more the norm, then you really have a rewiring of global supply chains. Catherine, I know you work closely with Tom Donilon, who we spoke to recently at the World Economic Forum. And when we talked to him, he mentioned tariffs as part of the new U.S. agenda. So what should investors be mindful of in the coming months with regards to trade policy? And should we expect more tariffs against more regions of the world?
So as you and I have discussed, as you discussed with Tom, trade is a central focus for the new administration. President Trump sees trade, particularly tariffs, as an all-purpose tool of economic and foreign policy. He believes tariffs can address a range of issues. Glenn touched on this, including reducing U.S. trade deficits, raising revenue for the country, negotiating with countries on matters of economic and national security, encouraging inbound investment to the U.S., sanctioning the non-use of the dollar. There's really a variety of uses in his mind. President Trump has been very clear in his intent to levy tariffs on a range of countries and products to advance his goals. In fact, on his first day in office, Trump directed various agencies to investigate and in some cases make recommendations on tariffs and other actions to deal with persistent U.S. trade deficits, unfair trade practices, and a host of security issues. Agencies are requested to report their findings by April 1st, so that's going to be a key signpost we're watching. But ahead of that, there's a number of geographies and product sets that we can look to as potential targets. Those include Europe. President Trump has said that tariffs will definitely happen with the European Union, indicating they are coming, quote, pretty soon. Trump has specifically called out U.S. trade deficits in auto and agricultural products with Europe, so I'd expect these areas at a minimum to be targeted. Europe has been preparing its response for some time, so the back and forth here is going to be important to watch. Second are the BRICS, the expanding group of emerging market countries that includes Brazil, Russia, India, China, and South Africa. Trump has threatened 100% tariffs on BRICS countries if they move to create a new currency or back any other currency to replace the dollar. Dollar diversification has been a big theme for many countries outside the West as governments look to protect their economies against broader volatility and potential sanctions. Third, beyond these geographies, Trump has threatened tariffs on specific products like semiconductors, oil and gas, pharmaceuticals, steel, aluminum, copper. The exact timing of these tariffs is uncertain, but I wouldn't be surprised if we saw some announcements before the end of the month. And last, I'm watching for the ways in which trade frictions might escalate further with China. One element of the president's executive order on trade was a specific request that agencies review China trade policy and other unfair economic practices by China. This could result in new investigations and tariffs. And additionally, in the U.S. Congress, lawmakers have introduced bipartisan, bicameral legislation to revoke China's permanent normal trade relations status. Revoking this designation would subject Chinese imports to significantly higher tariffs. So those are the areas I'm watching right now.
Catherine, when we've had you on in the past, we've talked about the mega forces, specifically the one around geopolitical fragmentation, which talks about how old trade alliances are changing, supply chains are being rewired. Talk to us a little bit more about how these developments around U.S. trade policy are playing into geopolitical tensions more broadly, specifically things like U.S.-China strategic competition, which you started to touch on.
Sure. So our view, even before the latest developments, was that geopolitical risk had increased substantially over the last half decade. And part of that, as you noted, is that the world has grown more protectionist. In the wake of the pandemic, Russia's invasion of Ukraine, the reaction to China's exporting of its excess industrial capacity, and other shocks, global protectionism has increased. Countries and companies are leveraging a range of tools to bolster their resilience, protect their national interests, and globalization is rewiring as a result. Now, there's an increasing number of trade restrictive measures in place across the world today. The World Trade Organization has reported on that. The latest actions by the U.S. mark a sharp escalation in this trend, and they will accelerate the rewiring of globalization that you and I discussed. When it comes to U.S.-China competition specifically, we see tensions as poised to increase across a range of dimensions, including trade, technology, defense, and more. So on trade, there's going to be this early period of tension over tariffs, as we've discussed. We could see some sort of agreement come out of that. But we're going to look to the findings of that trade policy review in early April for a signal as to any further actions the U.S. may take against China. In the technology space, the U.S. and China are engaged in an epic zero-sum competition to seize the commanding heights of advanced technologies. The new administration has emphasized AI leadership as key for U.S. economic and national security. And so we see a continued focus on tariffs and export controls, among other policy steps to further that goal, advance the AI infrastructure build-out in the U.S. And then last, in the military domain, tensions in the South China Sea are high. Conflict over Taiwan remains a risk. Additionally, the Trump administration is seeking to pressure China to bring Russia to the table for a potential peace deal in Ukraine. Across each of these areas, President Trump's advisors have strong views, but the ultimate decision of whether to escalate or not will come down to President Trump. So we'll have to listen to his words very carefully, as well as watch for any leader-to-leader dialogue with President Xi. These are going to be important signals for the relationship going forward.
And so, Glenn, we've been very focused talking about short-term developments as it relates to U.S. trade policy and tariffs. But if we zoom out a little bit and we think about some of the longer-term landscape here, what should investors be thinking about, both in terms of the risks and the opportunities?
I think it is important to zoom out at this point. And there is a bigger macro backdrop here. And you've discussed it in past bid podcasts, as I've heard. And before these tariffs came along, the world was already shaped by supply-side factors, big structural changes in production. And you mentioned it. We call them mega forces. And because of elevated levels of deficits and debt already, we're already facing a bit of a tug-of-war between things that may boost growth and things that may be a source of inflation. And with more limited fiscal and monetary policy maneuverability to course correct, this gets amplified. So when we're thinking about the mega forces, and Catherine, how she walked through the geopolitical fragmentation just now, lumping these tariffs into that just, again, amplifies the importance of that megaforce for identifying the path forward. And our central view is that it'll dampen growth and place higher pressures on inflation. How much and whether this becomes a stagnationary shock, I think depends on how long it continues to create uncertainty. And in particular, I would focus on that negotiating tool aspect of it. But there are still many other things to consider in terms of what are market-friendly developments going on. And two in particular to note, AI, the rise of AI and the three phases that we set out, build out, adoption, and transformation. Adoption feels much closer now with all the investments and the news we've been seeing and breakthroughs. The second is energy transition, the easing of energy regulations, and the mission to set out to reduce energy costs. If competitiveness can come down, that can be a good thing and a tailwind for growth.
Right. So your point is that despite the short-term headlines, there are still some longer-term structural trends that investors should be paying attention to that present investment opportunities. And what we've heard from investors is that they're not making many substantial changes in their portfolios right now. There's still a preference for equities, but we're also hearing that investors are looking for new ways to diversify, maybe looking for other asset classes beyond just things like bonds, for example, to diversify their portfolio. So it's definitely a very fluid situation. And we're going to learn a lot in the next couple of weeks, as you've mentioned, a couple of deadlines that will come up in early March that we have to keep a close eye on. Glenn and Catherine, thanks for enlightening us on U.S. trade policy and tariffs more broadly. And thank you for doing it here on The Bid.
Thanks for having us.
Thanks, Oscar.
Thanks for listening to this episode of The Bid. Next week, be sure to tune in when we talk to Jeff Rosenberg about the recent conundrum in bond markets and why short-term interest rates and long-term interest rates are moving in different directions. And subscribe to The Bid wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.